Okay, we're back. So we have two more budgets to do. We have our selling administrative expense and we have our budgeted income statement. So we just completed the cost of goods sold budget. So now we're going to do the selling administrative and we're also going to do the budgeted income statement. This is going to bring everything together that we just did. So selling administrative expenses, they've provided us an estimated operating expenses for December. So we can selling expenses, sales salary, okay, sales. So you need to pay your salesman. Advertising, that's part of your selling. If you don't advertise, you don't sell. Telephone expenses, only the selling. And travel expenses, only the selling. And this would be broken up by your company would have to break these up to provide you what is selling, what is administrative. So we have $92,550 in total selling. Now let's do our office salary expense. That doesn't deal with your operations, that deals with your office administration. That is the $21,000. Depreciation expense, office. Okay, that goes administrative. Telephone expense, administrative. Office supplies expense, that's not part of selling, so that's the $200, and miscellaneous administrative expenses. So then we can add those up together. So your total operating expenses are your total selling plus your total administrative. So we have $115,000 in total operating expenses. Now let's bring this whole entire budget together. Okay, so we're going to start with revenue from sales. This comes from your sales, total revenue from sales budget of $370,000. Your cost of goods sold, you just completed that. That is the $203,708 that we did in the cost of goods sold budget. So let's put that amount in. Okay, your difference between the two, the 370 minus the 203,708 gives you $166,290. That is your gross profit. Now we're looking at operating expenses. Selling, we just completed that. And you're selling and administrative expenses. Administrative, we figured that amount. So hopefully, if we did this right twice, we get the $115,000. Your income from operations. Remember, that is your revenues minus your expenses. So the $166,292 minus your $115,000, that gives you income from operations. Now we have other revenue. We have some other expenses. We have to pay taxes. So those are not part of the daily operations of the company. So we put those in a separate category. So interest revenue that we have received is $200. Expenses, we had some interest. We probably had a loan that we needed to pay. So that's $122. So I'm going to add and subtract. So we have a positive revenue. 200 is more than 122. If we had more expenses, that would be a negative. So our income before income taxes is the $51,370. They explained to us that we have estimated tax rate of 30%. So we can take our $51,370, we can take it times 30%. So we have $15,411 in taxes to pay. So we take the difference between our income before income taxes and our income tax expense, and we have net income of $35,959. And that completes a sales, production, a direct material, direct labor, factory overhead, a cost of goods sold, selling administrative expenses, and a budgeted income statement. And these are budget. This is an estimate. Okay, this is what companies go through when they're trying to determine what their net income is going to be. I will be doing a video later on the cash budget, so I look forward to having you listen. Thanks.